If you look where we are in the China cycle, it's probably comparable to subprime. They're 3 years into this leveraging situation and kind of a crappy domestic economy.
The stock market is up tremendously over the past week. It's the biggest rally in the Chinese market since 2008.
I think the rally's real. I think it has room to run. It's still cheap. It's still underowned. The equivalence of Amazon in China trading at like 8 times earnings. It's kind of like it just has to not implode, and that investment's going to be pretty interesting.
Today's episode of Monetary Matters is brought to you by Teucrium, a global leader in agricultural commodity ETFs. You'll be hearing more about Teucrium later on, but for now, let's get into today's interview. We've got a very important conversation. I'm speaking with Lyn Alden of Lyn Alden Investment Strategy. We're going to be talking all things in global markets in China. There are seismic moves in liquidity and the business cycle. Let's get into it. Welcome to Monetary Matters. How are you thinking about the business cycle, Lyn? As you know, for over 2 years, many economists and pundits have been worried that the US economy would go into a recession, and it hasn't. And the data seems weak, but then it gets better. I think you have an explanation for why this is the case that is really helpful and insightful. Tell us your thoughts on this.
Well, I've been in the fiscal dominance camp, which is another way of kind of saying that recessions or potential recessions in periods where fiscal authorities are running really hot can look different or be delayed or be, kind of just different than how we expect. So back in 2022, I was more in the recession camp, and we got a lot of indicators like PMIs rolling over, all sorts of liquidity indicators rolling over. Senior loan officer surveys were tightening to like recession levels. A lot of these soft areas. But then by toward the end of the year, and then really into kind of early 2023, we started to get this better liquidity environment. Basically, the rate hikes were ironically fueling larger fiscal deficits more than they were hurting some of the fixed rate debts that are out there, which is the majority of the debts. So like the investment grade corporate bonds and the fixed rate mortgages, that's a really big chunk of the debts that are out there. The more cyclical, the shorter term stuff is smaller, even though it's more interest rate sensitive. And we started to see a turn since then. And so I've been in the camp that sure, there are certain weak parts of the economy, particularly anything that's interest rate sensitive, or they got kind of pushed around by COVID timing, like things were pulled forward during COVID and then had to go through a period of kind of softness to make up for that. And so there are soft spots of the economy, but then there are other parts that have been pretty robust, like travel and things like that, that were delayed during COVID and were kind of pushed out. And a lot of the people spending on that are on the receiving side of these deficits. Um, and so basically, we're in this kind of structurally fiscally dominant period. If you look at just the credit cycle, if you look at bank lending, if you look at things like that in a microcosm, there's an argument that 2022 was well, it could have been a recession, or on its own was like a recession. But when you're running unusually large fiscal deficits, the total sum of that didn't really result in an unemployment cycle. It's possible that we still have an unemployment cycle ahead, but even if we do have that, I don't think the prior two recessions are a good descriptor of what that might look like, is basically how I'm approaching it. I'm kind of treating the recession or no recession questions on a sector by sector basis, because we've had unusually large divergence between loose fiscal and tight monetary, which means that you can have wider than normal performance gaps between different sectors of the economy.
Monetary policy is central bank, the Federal Reserve. Fiscal is the government. Congress is the government borrowing a lot of money, printing a lot of money. The answer to that is yes. You can have the data on what percentage of the fiscal deficit is of GDP and just why that's stimulating the economy. So there was no NBER, National Bureau of Economic Research, declared recession in 2022. Employment was still strong, production was still strong, spending was still very, very strong. So there was no recession. And even on the quarter over quarter GDP, that has been revised away. So there was no commonly agreed to set recession in 2022, full stop. But what you're saying is that the banking system and several other parts of the economy appeared as if they were in a recession. And you're absolutely right about this, Lyn. If you look at a chart from your research of how the percentage of banks that were tightening lending standards in 2022, it appeared just like it does in a recession. And actually, it almost looks as if we are emerging out of a recession. What does that indicate to you about where we are in the current economic cycle? Are we at the middle of a cycle? Are we at the end of an economic cycle? Are we at the beginning of an economic cycle? I mean, if I traditionally at the beginning of an economic cycle, other certain assets do well, certain types of the stock market do well, and towards the end, others do better than others. So where do you think we are in this business cycle or the liquidity cycle, and how is that shaping your outlook on various asset classes as well as sector outlooks?
Yeah, it's a good set of questions. I've been finding that the cycle analysis is less instructive. I kind of view us as in a potential rotation, which is to say that during this period there was a flight to quality because a lot of the interest rate stuff was what's pressured, and a lot of the non-interest rate sensitive stuff was fine. So, for example, if you're a profitable, cash-rich tech company or consumer staples company, or kind of low-cost retailer, and these things that are looked at as fairly bulletproof fundamentally, the high interest rates didn't really impact them. If anything, they have fixed rate debt locked in, and then they have cash balances that go up with interest rates, the interest income they get from that. And so investors kind of piled into those. And some of them I think are expensive, other ones are pretty reasonable. Um, and on the other hand, there's areas that have very much been impacted. I mean, I think commercial real estate's been impacted. I think it's going to continue to be impacted, but there's also super cheap areas that are actually like, not as bad as they looked a year ago. And then same thing when you look at emerging markets, when you look at cyclicals like industrials, manufacturing, some of those pockets are, if anything, showing signs of life or green shoots after what has been a pretty rough couple years. And so I'm kind of looking at this more of like a rotation than kind of that classic early, middle, or end of cycle analysis. Because when you look at, for example, emerging market economies, they don't go through cycles necessarily in the same way that the US economy goes through cycles. Um, and that could be because you're kind of running hot all the time. Like you're kind of have this background level of debasement that's higher, and so recessions look different there. They look more like currency crises. Um, and I think that basically in a fiscally dominant environment, or nearly fiscally dominant environment, developed markets get at least partial emerging market characteristics, not to the same magnitude, and they don't have the same like external debt problem. Like they don't have debts they can't print, so they're not. It's not quite the same thing, but you do start to get this kind of perpetually running hot scenario, which means that if recessions do happen, like if you back up and think, there's kind of two main types of recessions. One, in a classic like developed market recession, most people are not impacted. Like if the unemployment rate goes from 4% to 9%, something like 5% of people were impacted. They lost their jobs, and most people were not impacted almost at all, other than maybe being a little bit more concerned about their jobs and therefore not getting great raises that year. There's very minor impact for most people, but catastrophic impacts for a few people. Whereas, like for example, in Egypt, for example, they went through this kind of multi-year currency crisis. When you look at energy, like electricity consumption per capita, it's down, which is generally a really bad sign, like in terms of fundamental growth. Um, but it's not really like an unemployment cycle per se. It's not like the same type of this kind of credit cycle or this unemployment cycle. It's more like everybody got a little bit poorer. Like everybody can has more trouble going on international flights or buying foreign cars or buying computers, like any sort of imports or anything that involves outs or like food costs, fuel costs. Everybody kind of got this like haircut, or at least most people did. So it was a more dispersed type of recession. And so when you look at like 2022, the misery index spiked in the US, meaning that if you add unemployment to inflation, that spiked. And so there were a lot of people grumbling around, my groceries are going up faster than my wages, for example, and housing suddenly became unaffordable. Um, and so that's kind of the cycle we went through, and I think we're easing out of that. But I do think we could have a shift in terms of the types of entities that maybe get a little bit more love, and other ones that get a little bit less love because the conditions are changing. It's there's less pressure on interest rate sensitive entities, I think, going forward.
So you said something very interesting that in emerging markets, recessions tend to look like currency crises. And that's just because the domestic currency weakens and they're importing inflation from the rest of the world because whenever they buy something from the rest of the world on international markets, it costs way more because it's priced in the depreciated currency. So it's almost like the in emerging markets, they're still on the gold standard, but instead of the gold standard, it's the dollar standard. And when they have economic weakness, they can print money, but it weakens their currency, and that has you're basically importing inflation. Whereas developed markets and the ultimate developed market, America, when we have a recession, when America prints money, it tends to not devalue the currency, and if anything, the currency continues to strengthen around the rest of the world. Do I have that roughly right?
Yeah, roughly right. I would also add that developed markets generally have slower money supply growth. So we still have debasing currency, but it's less direct. It's less one for one because there is international demand for the currency. And then two, it's usually outside of like, 2020 and 2021, it's usually at a lower growth rate than emerging markets. And so they have a higher background rate of money supply growth, and then it's punctuated sometimes by these more outright currency crises because of either insolvent foreign debts or really rapid monetized fiscal deficits. Using Egypt as an example, again, their money supply growth averages over 20% per year, broad money supply. Whereas in the US, going back decades, the average is something like 7% per year. And so that's one specific kind of differential, and it'll depend on a country by country basis.
And so, how is this view that the US is gradually, in a small way, becoming more and more like an emerging market, as well as the fact that there won't be, or it's the odds of a traditional recession where the unemployment rate spikes is lower, and what is to come might be more of a scenario where inflation is higher or the dollar depreciates. How is that shaping your asset allocation? Because, Lynn, if I just take the first part, in other words, that the odds of a traditional developed market recession in the US is radically diminished. In other words, that the business cycle has been de-risked. To me, that sounds massively bullish for equities, because that one of the two threats to equities is a recession or inflation. What am I missing there? And just, yeah, what's your general asset allocation based off of this view you've been having?
So I don't think you're missing anything. I just think it has to be tempered by expectations. I've been structurally underweight long bonds, and instead I bias toward equities. I bias if I'm going to hold, bonds, I hold bills instead, or intermediate term tips and things like that. Or I replace some of the bonds with gold, which has done better than those long bonds over this period. So basically, it's a portfolio that's a little bit more geared toward running hot, even though it's not necessarily radically different than what you'd expect in a kind of a diversified, kind of traditional portfolio. The way that I've described it is a three pillar portfolio rather than a 60/40 portfolio. So you have one big pillar of equities, one big pillar of kind of cash equivalents or short term tips and things like that, intermediate term tips, and then a third pillar of either commodity producers or hard monies or both, like gold, Bitcoin, energy stocks, maybe some energy infrastructure, that kind of thing, which generally does better in that more debasement scenario, at least some combination of those assets. And so I've been in that camp where there's a lot of things I get concerned about in the economy, but there's very few of them that make me think I want to overweight long bonds, even though you can get a trade out of them. But when we're running 6% of GDP deficits or higher, as far as the eye can see, and the Congressional Budget Office expects about 20 trillion in net new Treasury issuance over the next 10 years. I'm not really thrilled at owning a 10-year Treasury at under 4% when I could own, a dividend aristocrat stock that's grown its dividend for 25 years in a row, pays me 2, 3, or 4%, but then historically grows that every year, and it has that kind of inbuilt kind of debasement protection into it. So that's really how I've been gearing toward it. The only concern I'd have is, there are like equity valuations can reach such height that even a certain debasement rate starts to make it so that they're not really going to compensate you. So I'm not blind to valuation when I try to be equity focused, and instead I try to shift around that equity focus to avoid areas that I perceive as potentially being a bubble. So like right now, I think there's a little bit too much emphasis on quality stocks. It depends on the stock. Mike Green would go into how like the passive bubble, for example. There's certain areas that I find a little bit concerning. They have kind of recursive investor demand. But outside of a couple pockets, yeah, I'm more equity focused.
Hey everyone, hope you're enjoying today's interview. As you may know, investors and advisors alike are rethinking the 60/40 portfolio, and many of them are turning to commodities for diversification. But for most investors, getting true exposure to commodities can be difficult. Direct ownership of futures contracts isn't suited for many investors, and they aren't even available in most brokerage accounts. And commodity equities are just that, equities. Finally, there's a solution. Teucrium's US agricultural ETFs can provide exposure to commodities like corn, wheat, soybeans, and sugar in a convenient size and ETF wrapper right in your traditional brokerage account. Visit teucrium.com to learn more. And now the disclosures. Diversification does not ensure a profit or protect against loss. An investor should consider investment objectives, risk, charges, and expenses carefully before investing. The prospectus contains this and other information. Read the prospectus carefully before investing. An investment in the fund involves risks, including possible loss of principal. Now let's get back to the interview. So, stocks over bonds, that has been the trade that has been working, and you expect it to continue to work. Let's talk about that very good performance and rich valuations, let's call it, in the high quality stocks. So, stocks like Costco have a price to earnings ratio of over 50. A stock like Chipotle has a price to earnings ratio of over 50. A company like FICO, Fair Isaacs, in terms of a FICO score, it is a very high quality business with recurring revenue. It has a price to earnings ratio now of over 100, which is quite a lot. I wonder what Charlie Munger or Warren Buffett think of talking about buying wonderful businesses. They are wonderful businesses, but they are not at a fair price. How are you making sense of this? Would you use the B word, bubble, to describe some pockets of these very richly valued, high quality businesses?
Yeah, the way that I've been managing that is like a lot of people kind of have this all-in thesis where they think, okay, like, good stocks are overvalued, so I want to own everything else, and then they get stuck in like gold miners for a decade. That's not the way I approach things. It's more like when I look at an area, I think, okay, well, first of all, I don't just do ETFs. I can look at individual stocks. So I can say, well, some of these quality ones look fine, other ones don't. Like I've been happy to own Visa for a while, compared to say Costco that I think is overpriced. And valuation doesn't tell you anything about what happens in the next 12 months. It just historically has a pretty good performance for telling you what's going to happen in, say, 5, 10 years. Because I aim for low portfolio turnover, I care about those types of outcomes rather than trying to trade things in and out frequently. So I look at both sectors and types, but then also like break it down into individual companies. Which ones do I want to own? Um, and so I have owned a decent amount of tech. I have owned a decent amount of quality, but it's I just spread out more to other areas also. And in those quality or tech areas, I try to own some over the other. And then like there are some assets like Bitcoin or, for example, MicroStrategy is like the only stock that kept up with Nvidia. So I kind of missed out on this recent like Nvidia run. I owned their prior big run, right? And so I owned Nvidia. They went up a couple, few 100%. I sold it. They had a big correction. I almost got back in, and then it kind of ran away from me again. But instead, I owned MicroStrategy, which is like one of the few stocks to kind of keep up. So it's really about that managing of not being that kind of perma bear on U.S. mega cap stuff, and just basically saying, you want to watch out for risk and maybe look elsewhere where there's a couple low hanging fruit that you can pick as well. An analogy I've used is that in the late 90s, everybody was focused on the dot-com bubble, right? Everybody talks about what Cisco was valued at and all that, but Coca-Cola was trading at over 50 times earnings. Walmart was trading at over 50 times earnings. And what happened over the next 10 years was that their fundamentals did fine. These were blue chip stocks that continued to expand globally and make more money, revenue and earnings, but their stocks went nowhere for 10 years because their valuations steadily fell back down to the 20s, or in Walmart's case, even lower for a period of time. So if you cut your valuation in half, but your earnings double, you run nowhere for a decade. And so when I look at companies like Costco, I think this is an amazing company. It's one of the few companies that customers like, shareholders like, and employees like. Usually you only get like, one or two out of the three. They hit all three. Everybody likes Costco, but I just don't love Costco at 50 some times earnings. I think it's worth a premium multiple, but that like right now is like a higher multiple than Nvidia. Um, and so, I would exercise caution and think that just because you have debasement doesn't mean that things can't get stretched enough that they still give you like 5-year lackluster returns. Is how I would describe it. It's all about risk management.
Thank you. And Lynn, so what has been rallying is quality, high quality businesses and the one cyclical sector is semiconductors, but we have not had a risk on rally in terms of the stuff that's been rallying the most has been like low quality steel companies or junk companies that are just IPO'd. That was what happened in 2021. This market has been defined by high quality companies growing their earnings and their valuations going up a ton, not by junk rallying or even lower quality companies with a much cheaper valuation rallying. So nothing like 2021, in my view. Uh, Based on my reading of your work, it does seem like you do think there will be something of a risk on rally, and that is what you mean by rotation, that it will go to the more cyclical type of companies. Can you just tell us, well, why you think that's the case, as well as what sectors are going to do the best in your view, as well as just how you see that playing out?
So I think that a lot of the less quality stuff or more cyclical stuff is more rate sensitive on average, and so as we enter a rate cutting cycle, I think those are the companies that stand more to benefit from that. And some of that's because it could be because they're domestic and they're just they're more asset heavy or they're more pressured by those high rates, or they're in emerging markets and when the U.S. runs pretty loose fiscal and pretty tight monetary policy, that tends to kind of squeeze a lot of emerging markets. They've had to raise their rates super high to kind of make sure they don't run into like a currency impairment relative to their dollar-denominated debt. And so they've kind of a lot of them are like coiled springs that have really had to hold themselves back to kind of get through this kind of pretty aggressive Fed tightening cycle. Um, and the way that I've kind of put it is that you know there's a lot of investors that have been always on the lookout for like this like U.S. to international rotation, for example, um, and it's very easy to be premature on that. But the way I would describe it is that there's certain conditions that at least increase the odds of having one of those rotations. So, for example, back in 2019 was the last time that there was a potential for a rotation because we were going through this like domestic U.S. softening. We started to get a mild rate cut cycle. By the end of the year, we had the repo spike, and then we went back to balance sheet increases because of that. And this was kind of setting the stage, I think, for potential rotation, but then COVID came along and everything, kind of blew up, right? So we didn't get that rotation and everything is kind of shifted even more to one side of the boat. So all this global capital stuffed into the US and we're going through another rate cutting cycle. So it's the first kind of serious time in 5 years where there's at least a potential for rotation. I think the odds are higher this time. Doesn't mean it's guaranteed. And I've been watching, kind of news in some of these other areas, like stimulus out of China, for example. It's uninvestable, and then they're coming in to stimulate, or certain pockets of Latin America, or one of the areas I like is kind of quality cyclicals. So just high quality industrials or financials in the United States or elsewhere that have pretty good long-term quality characteristics, but they are either rate sensitive or they're cyclical in some way. And those tend to be the types of assets that I'm into, not really like the no profit like tech
Mhm.
stock usually. I mean, I'm a general partner in a venture firm. I leave kind of those bets for venture. In public markets, I generally look for more profitable types of entities.
Right. And when you say you think the odds are increasing and getting higher of a rotation from the US to the rest of the world, I can infer from that that you are bullish on emerging market equities. Just how bullish are you? And then also, what is the going to be the catalyst for that? Let's go back the previous mega bull market in emerging market equities from 2000 to 2007. Okay, yes, you had a China was growing very quickly. You had a global commodity boom, and a lot of emerging market countries, such as Brazil, produce a lot of commodities like oil. But what else was it about that period that led to such drastic outperformance of emerging markets? And why do you think the odds of that could be increasing for that to happen again? And then we'll get into China.
So the first answer is I'm bullish, but less bullish than that period. That was a tremendously bullish cycle. That would not be anywhere near my base case. The conditions were there were so going into the late 90s. The U.S. was outperforming. A lot of capital was stuffed into U.S. markets. There was a classic strong dollar emerging market crisis. Um, and then when eventually the U.S. economy softened in the early 2000s, we got all these rate cuts and all this global capital that was all stuffed into the U.S. and everybody else was kind of impaired. That capital started to come out and started to go elsewhere. And the vicious cycle of the late 90s turned into the virtuous cycle of the early 2000s, which is there's these cheap areas. They've been weighed down by their dollar denominated debt. Nobody wants to invest there. And then around the margins, you usually start to get some interest there, and that eases like their currency kind of starts holding up a little bit better versus the dollar, and that makes their kind of liquidity situation better, their solvency situation better, and then that's like looks like green shoots. So then you see more investors want to maybe get in, and then that actually can further help their currency relative to the dollar, and you get that kind of virtuous flywheel that can last 3, 5, 7 years. And give you a kind of a classic emerging market cycle. And because those are more, they have lower per capita commodity usage generally, and so when they have marginal growth, it tends to be pretty physical. So it's not really surprising that emerging market cycles tend to correlate with pretty good commodity cycles as well. Some of them are producers, but then in general, they just they have more physical economies at that level. They're less financialized. Basically, the conditions that kind of go together are one, a abnormally high percentage of capital stuffed into the U.S. Right. So, for example, in the 2008 crisis, when we had a big rate cutting cycle, that was at a time when we did not have a lot of global capital stuffed into the US. It was already because of that really good kind of 2000 2007 brick cycle, it was already dispersed elsewhere. So we did go through a cutting cycle, but it's not like there was all this capital stuffed into the US that could then disperse. Um, and 2019 cutting cycle, we kind of had those conditions again, but then, like I mentioned, COVID and other factors and AI and all these other things kind of overrode any potential rotation there. So this is kind of the next chance where it looks kind of like that early 2000 environment where we have kind of a lot of interest in U.S. mega cap stocks, a lot of global capital stuffed into U.S. markets, combined with a rate cutting cycle, and you know we could get a pandemic, we could get a war, we could get there's all sorts of things that could derail it. We could get very specific ongoing tech breakthroughs, like in this case AI. Um, but I think that the conditions are better for potential rotation. When you look at valuations, when you look at this kind of easing cycle, when you look at the willingness for certain other economies to stimulate. Um, but we don't have like the sheer like demographics and build out of China, that we had back then, like in the early 2000s. There's not really any country that can replace that. I mean, India's pretty strong, but it's not like that. So I think it's more of a moderate type of cycle is how my base case would be. So I'm fairly bullish on emerging markets. I think you have to manage your position size somewhat. And around the margins, there's already been some rotations. Like I've pointed out that if you look at Latin American equities on a total return basis, because they do pay higher dividends on average, they bottomed versus U.S. stocks in like late 2021, and since then it's kind of been chopping sideways. And they went back to underperforming, but they haven't gotten to like lower lows on that total return dividend adjusted basis. Maybe they will, maybe they won't, but basically that's already been like a multi-year period of no longer underperforming. The rest of the emerging markets were weighed down by particularly bad performance out of Chinese equities. I think there's a decent chance that Chinese equities have bottomed here. Um, Now that doesn't mean that the ratio, bottoms here, but I do think that kind of whole segment is getting pretty interesting. Again, on that kind of cycle basis, so that kind of 3 to 5 year capital rotation cycle.
So earlier you talked about BRICS. That's Brazil, Russia, India, China, South Africa, the old emerging markets. Russia, for obvious reasons, is out of the picture. Uh, India has been growing enormously. The stock market has also been rallying a lot, so the price to earnings ratio is higher. China, your economy has been having a lot of issues, and the stock market up until a week ago was in a vicious bear market. Probably price declines in the order of 60% on the 60 to 70% for individual stocks, as high as 80% drawdowns. But Lyn, a week ago, 6 days ago, we received some news from the People's Bank of China as well as the Chinese government. They were cutting interest rates, they were cutting the reserve requirements, and they were creating a facility to lend to institutional investors for them to buy stocks. And they also did a trial balloon of a whole host of other policies, including with the government, of giving people money, doing direct fiscal stimulus, helping out the local governments, lending money to local governments to buy unfinished homes, because there's the real estate market, it was a bubble, and it has popped and prices are declining, to try and stem the implosion of the property market. And the stock market has reacted accordingly. The stock market is up tremendously over the past week. It's the biggest rally in the Chinese market since 2008. How are you thinking about this stimulus, Lyn? Is it for real? Is it going to actually improve the Chinese economy as well as the Chinese stock market? Or is this just a fizzle that's going to last for a week and then the declines will continue? How are you thinking about this?
So over the past month or more, I've been writing increasingly about China because we started to get more and more toward what looked like a red zone for them in terms of how they kind of manage their risk reward. So basically, China is going through a property deleveraging cycle, as you pointed out. That's weighing down commercial investment, and then it's also weighing down consumer confidence and overall, the wealth effect, consumer kind of just their ability and desire to spend. So weak domestic economy, but good exports has kind of been the Chinese story for a while. Um, and what I started to notice is that their online social media was getting pretty annoyed at the current situation. So if we go back to their COVID policy, they had this whole zero COVID policy for quite a while, and eventually they started to get kind of widespread protests, which is pretty rare. And they backed out of zero COVID pretty quickly once that happened. It was kind of no longer seen as socially stable, which is a big priority for how they run things. And so they pivoted out of it. They didn't really pivot out with stimulus, but they did pivot out with like lockdown policies and things like that. Um, and we were starting to see less extreme uh, but like still increasingly noticeable dissatisfaction in the state of the economy on Chinese social media. People were calling it garbage time, which is a sports term for basically when the game's effectively over, but and all the good players are swapped out, but they're still playing, and the game sucks now. There's also really kind of clever ways to criticize the government by basically people saying, "Hey, remember this like Chinese emperor from the 1400s and the mistakes he made?" And it's like clearly it's kind of just it's a good way to get around algorithms or have plausible deniability rather than saying, "Hey, the current president's bad" or whatever, which is you get in trouble for. Um, and so there was increasing dissatisfaction, and they were increasingly at risk of not hitting their own self-imposed growth targets the way that they choose to measure them. And so basically they kind of have multiple priorities right now because China wants to internationalize their bond market. So they want to have a credible currency and bond market that their trading partners can hold for periods of time and expect that they can then use it to buy Chinese goods and services at some date in the future without too much debasement. So they want to have international confidence there, but then they don't want to have such a weak state of the domestic economy that they start to get social upheaval or civil like protests or things like that. And I think the pain point has just finally begun to shift more and more toward they don't really want stocks to go below where they are now. They don't really want consumer confidence to keep tumbling. They want to kind of balance that out. And then the ironic thing is at a certain point, if they stimulate, it's not necessarily bad for the currency. Like basically because on one hand it's unintuitive because if you're going to be willing to kind of print more currency units to stimulate, you would think it'd be negative for the currency. But if that entices some marginal global investors to come back into your market, and see signs of life there, then that can offset the fact that you're potentially willing to stimulate. So they can it got I think that the scales got so tilted that their kind of two goals weren't really in conflict anymore. Um, and I think that the way that I've interpreted this, I think that investors maybe are making a little bit too much of it in the near term. This is like the equivalent of a multi-hundred-billion-dollar stimulus, not like a trillion-dollar stimulus. But I think in the longer term, people are underestimating it because I think it's more of a floor. I think they're kind of putting a floor under the current like economic environment. And should this round kind of fail to start like a little bit more positive cycle, I wouldn't be surprised to see another kind of small to moderate round again. And I think it's just basically that it's more of a finding out of where their pain point is and where their priorities start to shift from one side of the pendulum to the other. And so, barring major tail risks like a waking up to a Taiwan headline or something, I'm fairly bullish on Chinese equities with say a 3-year view, just with the caveat that obviously you get position sizes and risks around some of those geopolitical tail risks.
And there's the fundamental case that the Chinese economy is going to improve because of stimulus measures, and investor appetite for stocks is going to improve because the central bank is blessing investment of the stock market and is putting a floor on the real estate market. Uh, there's also the more short term speculative flow of everyone was short Chinese equities or underweight Chinese equities, and this is a drastic change in sentiment. Do you have a gut feeling or a sense that you feel an inclination that you feel comfortable sharing about just how offsides this the global investment community was? I mean, the headline on Bloomberg.com now is that quant funds that were short Chinese index futures are getting margin calls. Now, interestingly, the actual Chinese stock market today and the U.S. markets are actually down slightly 1%. But this does appear, Lyn, as like in March 2020, I believe the bottom of the S&P 500 was March 23rd. And from that vicious sell-off, that really true was very vicious, you had a ferocious rally upwards that lasted until the high in early January 2022. But for most of the first month or first few months of that rally, so many commentators said this is a bear market rally and beware of just how strong the market is going up. But it seems like this Chinese stock market wants to go up. I don't know. What do you think?
Yeah, so I get nervous whenever I see a really quick vertical move. It's like my expectation for like the next week wouldn't be great at that point. But I do think that there's a high likelihood that the bottom is in, and that this thing could run for a couple years or a few years. Um, when you look at so there was like a perfect storm of events that pushed Chinese stocks down. One is that the president went after the tech stocks themselves. They went after Jack Ma, for example. They put these big new taxes on certain of them. They basically kind of pulled capital out of these big mega caps, and they dispersed it more. Is kind of what they did, which is not, if you're an investor, you're like, well, why do I want to own any of this then? And then when Russia invades Ukraine, and then American investors get cut off from their Russian assets that in some cases are still doing fine. Just you just don't really own them anymore. Um, People were like, well, what if China does something similar, and then you wake up and you're just zeroed out of certain assets? And so the combination of self-imposed just anti-stock actions combined with geopolitical things made a lot of investors, I think, somewhat rightfully look at China as uninvestable. But then when you start to run into these economic pain points, and the valuations are incredibly low, right? So there's like the equivalents of Amazon in China trading at like 8 times earnings, or like the higher end like 17 times earnings or something, depending on the company. It's kind of like it just has to not implode, and that investment's going to be pretty interesting. Then some of them became more shareholder friendly because they're going through this long bear market, and then they're initiating share repurchases, they're initiating dividends in some cases. They've gone through certain reforms, and the government kind of shifted from, let's pillage from the stocks and disperse that capital. So, oh, why does nobody want to own our stocks? Let's we're not going to do that again, guys. We promise. And it kind of helps set that floor. So I do think that the barring certain tail risks, I think the rally's real. I think it has room to run. It's still cheap. It's still under owned, but it doesn't mean that a short covering rally is going to continue with that momentum. So I'd have kind of patient expectations around kind of future decent performance out of these assets.
And within the Chinese stock market, which types are you bullish on, and why?
I still have concerns around their real estate market, despite the fact that it's already a lot of the air is already out of that bubble. There's still valuation concerns, and there are still big pockets of leverage in there, and it's just more opaque than I like. As someone who's not going to specialize in China, there's certain opaque areas that I just don't, I don't have an edge to go into. I've been preferring to play it from the top down, which is to either own the index, or own some of those big tech stocks or big mega cap stocks that you mentioned. They're the ones that I think you can trust the numbers more. Those are the ones that, if all these foreign investors consider China uninvestable and then start to consider it marginally investable again, they're the ones that they're going to go in and buy. Um, Now, domestic confidence is a different matter, right? I mean, if they're still if consumers are still suffering some wealth effect issues from their real estate going down, they might not have a lot of capital to deploy into stocks, which is now offset by the fact that the government wants to directly stimulate stocks. So I'm not bearish on those smaller ones. Just they're not the way that I'm approaching it as an American investor. I'm approaching it mainly from top-down broad exposure with kind of gearing toward less leveraged types of entities.
Hmm. So basically, companies that would dominate the big indices. And is there a reason why you like the tech sector more than other sectors?
They're like growth tech stocks at like value stock prices. That's where I think that there's pretty obvious dislocations. Um, and but again, it's like broad based. I mean, there's like toll road companies that I think look good. Like there's a lot of cheapness kind of broad throughout the whole space. Um, and it's just that some of them are bigger, more visible than others. And as someone who doesn't specialize in Asian equities, I'm a pretty broad discretionary investor. I have to kind of know my limits for how much detail I can get into in any one uh, type of non-concentrated bet.
Mm, that makes sense. And so China is still an emerging market. How do you think of its business cycle? If you said emerging markets have a different business cycle when their unemployment rate doesn't spike and there's deflation, there's inflation as the currency depreciates. Is that true of China? Because as I learned from you, China actually, unlike a lot of emerging markets countries, does not have a lot of dollar denominated debt. As well, they have a huge stockpile of treasuries. So, how are you thinking about this business cycle as well as the economy? Because if you look at only real growth, yes, nominal growth in China has been going down, but there's been deflation or exceptionally low inflation, basically zero. So real growth in China has been higher than in the U.S. But again, it's a question of how you measure that. But yeah, just how weak is the Chinese economy? And I mean, do you think that they will have to change their growth model or get used to lower growth, as well as just your overall thoughts on the economy?
So for the first question for emerging markets, I don't really view them as a classic emerging market. When MSCI, for example, classifies emerging markets, they put like South Korea and Taiwan in the emerging bucket, even though they're pretty high per capita development and most of their most of their debts in their own currencies. China, outside of certain pockets, the vast majority of their debt is in their own currency. They have, you know, weak demographics now, more like a developed market. Um, so I don't really view them as an emerging market anymore, even though they're still their per capita economic development is kind of the one thing that still has more room to run in that regard. Um, as far as the state of the economy, I think yeah, the growth is going to be slower now. Um, I'm not in the camp that they're going to have like 3 decades of no growth like Japan because they've run into this demographics issue at a lower development point. So there's still some low hanging fruit, for example, to double your, real GDP per capita over a sufficiently long period of time, and for more people to consume more resources and kind of elevate their quality of life up to, what people generally have in developed countries. So I think that as avoiding major fumbles, that there's still growth opportunity there, just not at the same speed that investors became accustomed to until a few years ago. In addition, the like Japan had, I mean, Japan's bubble in the late '80s was like the biggest bubble as a percentage of any one economy like ever. Um, like their stock market capitalization surpassed the U.S. during that bubble. Their like Schiller PE, their CAPE ratio was like double what we had in the dot-com bubble. And then they had a real estate sector bubble at the same time. Uh, China, their bubble was mostly focused on the real estate sector. They never really had a stock bubble. They weren't, at their peak, they weren't super cheap, but they weren't really in a bubble. And it was mostly just a real estate and leverage bubble, which they're working through. And they don't really have that equity bubble along with it. Now, if anything, they're really cheap. And so the combination of valuation differences and per capita economic development reasons, I'm less bearish on China than like kind of the those that compare it to Japan. Even though I do think that yeah, we're gonna have slower growth going forward.
So you think China won't be as bad as Japan because it's a less developed economy, so they have more room to go. And when you're less developed, it's easier to grow because you're starting from a lower level. Do you think that the effects, the basically negative wealth effect of a real estate bubble imploding, will be less negative for China now than it was for Japan in the 1990s, or it was for the US or in Europe in 2008, 2009? I'll read from LynAlden.com a recent piece. You say, what China is going through now is similar to what the United States went through after the subprime mortgage crisis. China's real estate sector was incredibly overvalued and levered, and for years it's been deleveraging and dropping in price, which is negatively impacting consumer spending via a negative wealth effect. Do you have any reason to think that this won't be as bad as when a bubble pops, it massively impacts people's psychology, and they are going to spend less money, and they're going to feel less wealthy, and they're going to spend less money, and then firms that employ them are going to let people go, and it's a deflationary spiral. And the worst they can get it, for example, the most extreme example, of course, is the Great Depression. Um, do you how what is your reasoning for thinking that it might be less bad than Japan in the 1990s or subprime?
Well, actually, I think it's probably comparable to subprime. If you look at, for example, the Case Shiller like home price index, that didn't bottom until like 2012. So even though we were out of the recession and we started to kind of grow back, the real estate sector continued to undergo issues for another like 3 years. Um, and if you look where we are in the China cycle, I mean, they peaked in what 2021, and they're like 3 years into this like deleveraging situation and kind of a crappy domestic economy. So it's not really that I think it's different than subprime. I think we're kind of like 3 years into their subprime, where we might like we might be hitting the 2012 moment of China, which could be the 2024 2025 moment for them. Um, and I think that we're seeing going back to the prior points about the this array of stimulus that's been announced. I think they're basically saying, okay, I think we've hit points where it's not really useful to anyone domestically to keep going through that for another 2 3 years. And that doesn't mean that they pivot right out of it right away, but I think you start putting a floor under it and start grinding up. And just because the Case Shiller index bottomed in 2012, it doesn't mean that 2013 was a particularly banger year. It just kind of just quietly started to recover, and we went through a very long cycle after that. Um, so I think China is more in that subprime, like 3 years into that subprime situation. Um, Whereas Japan, like again, their bubble was insane. Like their real estate bubble and their equity bubble together were just catastrophic. And China only really had that chunk of it, that subprime real estate focused chunk of it, and not to the necessarily the same degree in terms of percentage. So I think that's basically how I'm approaching it. Is more like that subprime situation. In addition, their export sector is a continued lifeline for them. One of the headlines I've focused on repeatedly that I think's not gotten a lot of attention is that over the past 3.5 years or so, China quietly became the biggest car exporter. But you had like this flat amount of very low exports, and then it just hockey sticked up for 3 years, and it hasn't really stopped yet. They kind of hit critical mass, moved up like the capital spectrum. So instead of just making parts, they're making full cars that people in other countries actually want to drive. And it's kind of invisible to Americans because we don't see these on American streets. You see them on streets in Cairo or streets in Brazil, or they're selling to other BRICS nations. They're selling to emerging market nations, and they are selling at a pretty low price for decent quality. And so when you go to those markets where a lot of people like ride mopeds, they can now upgrade to cars that are cheaper than anything you'll find in the U.S. But that function pretty well. And it's kind of like how South Korea like increased the quality spectrum over time for their cars. I think we're going to see a similar cycle for China. And I think Another industry that's behind that, but maybe is still to come, is their aviation industry. So, they have like 15 years in development for their first commercial airplane. Comac is their company, and I think they named it Comac because you have Airbus, Boeing, and then Comac, so
Hmm.
ABCs of aviation. Now they actually technically still have to catch up to Embraer of Brazil, but they have kind of the whole weight of Chinese industry behind them. And that takes longer than cars, but I think eventually you could see a hockey stick of airplanes in 5 or 10 years. So I still think they have um, export juice left in their tank, and it's mainly around, how much do they want their domestic deleveraging to go? How much are they kind of willing to go through that malaise until they find pain points enough to stimulate? And I think they're kind of finding those levels now.
And amid the economic implosion of the real estate bubble going down in China, as you say, exports have continued to boom in China, and the data on their exports and growth in electric vehicles and 3D printing, battery technology, advanced manufacturing products is anywhere from 20 to 50% according to the Chinese data. And for example, the electric vehicle dominance, I think of the firm BYD, which the late Charlie Munger was an investor in. And so do you see a lot of opportunities in companies that are the stocks that are the big Chinese exporters, BYD exporting electric vehicles to the rest of the world, um, battery manufacturers, and the like? Because I think of the large cap Chinese tech stocks that dominate the ETFs and the indices, they are a lot of them are very exposed to the Chinese consumer rather than exports. It's my understanding.
I have some concerns around, say, for their export vehicles margins and things like that. It's kind of almost like instead I want to own the things that their workers are going to buy, right? So they're gonna buy from like the likes of JD, for
Mhm.
example. Um, and so I think that does fuel into the domestic economy indirectly, especially when you also have the domestic stuff's very cheap and potentially turning around. Um, so I think that investors that want to dig through which specific exporting company they want over a different one and what their margins look like and how they're what they how they compare to Tesla. um, I again kind of focus more on the index or some of the big ones, because I think that indirectly ties into those strong exports and with less risk. Like there's less, like an unprofitable or razor thin margin export business. Uh, you can keep increasing your revenue, but it doesn't necessarily always transfer to shareholder value. Um, and so it's just not been a big focus of mine, other than that is impactful for the broader Chinese economy. I mean, if you look at just their real estate sector, you'd think that they're in a depression.
Yeah.
And then you think, well, why are they not in a depression? So, well, look at their car exports. So, someone's making money from all those. Um, and there's things like that. So I think it's part of the holistic view on China, is how I'm approaching it.
And then, so if China continues to have a massive trade surplus with the rest of the world, what are they going to be doing with those dollars and euros? Are they going to be plowing them into U.S. Treasuries and sovereign bonds of other governments as they have? And I guess this is a transition to your view on who will be the marginal buyer of U.S. Treasuries as the U.S. government continues to be a very large borrower.
So China's treasury holdings peaked in something like 2013 or 2014. They've gone steadily down. They even announced it at the time and basically said it's no longer in our interest to keep accumulating these. They started to instead invest more into like Belt and Road Initiative type stuff, marginally increase their gold holdings. Some people have reasonable speculation that their gold holdings are higher than they stated, but that a lot of that just could be private sector buying. Either way, there's a lot of gold in China. Basically, I think that they're going to hold a lot of assets aside from treasuries. I don't, not that the treasury is necessarily going to go to zero, but that they just don't want this big, gigantic kind of unilateral exposure to, um, the U.S. government. Um, I think they're gonna redeploy that elsewhere, broadly. Um, I've had the view that kind of gold is gradually reasserting itself into the global reserves like system over time. Technically, that bottomed in like 2009. Like if you look at central bank gold tonnage, it was on this like multi-decade decline until like 2009, and then it kind of started like a V and started going back up again.
Gold
It
tonnage
obviously
as a percentage of total assets?
it's raw gold tonnage.
Okay.
Yeah, raw gold tonnage, and as a percentage of assets, it's kind of chopping sideways to up. I think we've seen the bottom both in tonnage and in terms of percentage of assets. Um, and I think that there's just more interest in holding gold around the margins. I do think you'll still see some treasury purchases by foreign sectors, but the question is how much do they own? Like if you look at foreign holdings as a percentage of treasury securities outstanding, that's been on a pretty significant decline for years. I think that probably stays, roughly where it's at, or maybe continues to go down a little bit. Um, for who buys it, I think it'll depend on the time frame. I think partially it'll be bought by domestic non-bank investors, partially by international investors, just not in super high amounts. We've already seen banks go back to buying treasuries. So for like a 2-year period, their treasury books were shrinking. They're back to buying now. And there is all, if they run into liquidity issues in the treasury market, they have levers they can pull to change regulations to make it easier for banks to buy more. Um, by roughly late 2025, perhaps, I think we'll go back to mild Fed balance sheet increases of treasuries. If you look at they had a 2023 annual report that was published in early 2024, and they had these long-term balance sheet projections. And they basically projected that at, roughly in 2025, they'll kind of hit their floor, and then they'll increase their balance sheet in line with GDP so that they stay at a fairly static percentage of GDP. And specifically, they want to keep trimming off their mortgage book while going back to treasury accumulation. So I think that basically there's going to be multiple buyers. I think, depending on what time frame you have central bank, you have commercial banks, you'll have some non-banks domestic, and then you'll have some foreign. And wherever there's a deficiency, it's basically the banks and the central bank that kind of step in if you have any sort of liquidity issue or kind of dislocation in yields. Um, they can just kind of switch around whatever level is their pain point. They can switch the levers around.
So in 2020, there's a huge amount of treasury issuance that was bought by the U.S. Federal Reserve and U.S. commercial banks. Since 2022, it's commercial banks and the Federal Reserve have been reducing their treasury of holdings. So it really has been the American private sector, so households and corporations, that have been the buyer, as well as just yields going up. What do you think about the long-term sustainability of the treasury market if deficits continue to increase?
So I think it'll probably not do well in real terms. Like earlier in the discussion, I point out that long bonds are not particularly attractive to me under 4% yields when we're running structural deficits this big, and in a world where probably we go back to some degree of monetization in the next year or two. Um, but I don't, if they start to get a situation like, for example, what the UK went through in 2022, the gilt crisis, they basically went back to temporary QE, put out the fire, and then kind of carried on. Now because they have a parliamentary system, they had more political repercussions from that. I think the U.S. the pain point is higher. Basically, if you get like serious dislocations in the treasury market, some sort of a liquid event, um, they reliquify it. So for the past couple of years, one of the biggest sources have been reverse repos. Money's kind of, and that's like basically money markets are kind of just changing the composition from reverse repos to things like T-bills over time. We've had, there was that paper on activist treasury
Mhm.
issuance, basically the purposeful issuance of more T-bills. That's something I haven't used that term, but I've been kind of pointing to that kind of the Treasury's been somewhat offsetting the Fed because there's different liquidity levers to pull. And I think that eventually, when we run out of like reverse repos, and they basically run into the floor of bank reserves, they'll basically the Fed will go back to gradual balance sheet increases, and they're not going to call it QE, but they're going to call it just maintaining ample reserves in the system. They can do SLR adjustments if they really want to. There's political opposition, but that's a tool that they have. Um, and I think basically it's you get some degree of mild financial repression, which is that you make it easy to hold treasuries. You have all these facilities that give you plenty of liquidity when you need to swap back and forth to other assets. You weight things toward like just making it like prioritize holding treasuries. And entities that kind of hold them on leverage do okay. But if you're just like a consumer investor, if you're sitting there holding treasuries, I think you're gonna get like devalued over time compared to a lot of other assets that you could be holding.
So your base case, or you think it's more likely that if there's a bad scenario for Treasury investors or the Treasury market, it is just in underperformance rather than a crisis, and that the actions done to smooth out the crisis and make sure everything goes smoothly, that may result in inflation or underperformance, but that the odds of a true crisis are lower.
Yeah, I think you could have mini crises. I mean, we had some mini crises. Like when we had a interview like a year ago, we were talking about like bond dislocations, and I had been concerned around that. Um, I think you punctuate between nominal losses and real losses, depending on whichever one they perceive as being less painful at the time. When inflation's running really hot, they're more likely to let nominal losses pile up to a certain degree, and if inflation's down, they're maybe more likely to gear a little bit more toward liquidity and inflation. And so I think that this is like the meme I use is nothing stops this train. I think this is a long-term story. It's not like something that, like when people ask when did America have a debt crisis, it's like this whole period. We're basically holding anything other than bonds was better than bonds. It's like if you had to point to a day where bonds are a problem. There are a couple major spikes on the move index, and like yield dislocations. Like September of 2022, for example, was kind of a mini bond crisis, and it's hit the gilt market harder. Um, I think you kind of have mini crises, and that they shift then to whatever's the release valve, and then that builds up, and you kind of shift back in another direction. So I think it's a slow motion boiling of the frog for for entities that are holding treasuries for years and years at a time.
With slow motion boiling of the frog, so the frog doesn't leave the pot. But ultimately, not to be graphic, but the frog dies because it's too hot, even though it doesn't feel it. Are you what is that equivalent for the treasury market?
I think the equivalent is that developed market currencies, like including the dollar, get more emerging market like characteristics, right? So I think that we basically have higher background inflation offset by whatever productivity gains we get in AI and things like that. And if you get a ton of productivity and you get monetize fiscal deficits, then it's good for asset prices instead. So instead of it either goes toward consumer prices if you have bottlenecks in energy or manufacturing or services employment, things like that. If you don't get bottlenecks there, it piles into generally financial assets, Bitcoin, gold, high quality stocks, high quality real estate. It piles into those types of things. And so at the end of the day, these long-term bondholders, I think, are going to keep just like their purchasing power is not going to appreciate compared to most other assets you could hold. Now, that doesn't mean that there can be really good trades. If you do get like an unemployment spike from 4.2 to 5.2 over a given period, maybe bonds do really well in that 6 or 12 months. Like it's a tradable asset. But I think that basically anyone who just finds themselves holding them for 5, 10 years is going to continue to find other things running away from them. Um, we've already had a long period of that, but I don't really see a strong sign that that's over per se.
Right. And I think it's important to ground for our audience that, people who are just approaching retirement age, or people maybe who spent their approaching retirement age and have spent their entire life in the financial markets, they have lived through a unique period where they started their career in the 1980s when interest rates were at near all-time highs, and then approached all time, then went to all-time lows. And, you're not going to have a 20,000 basis point decline in interest rates over the next 40 years. You're just not. So backtest should be used sparingly.
Yeah, exactly. Yeah, I mean, if the treasury market just fluctuates between 2% and 6%, let's call it, pretty wide range over the next 10, 20 years, that's not a particularly attractive asset class to hold unless you're trimming as much as you can at the top and trying to kind of swing trade that or something. I'd be cautious about, real returns of the asset class.
Right. So real returns is inflation adjusted returns. One thing we haven't talked about, Lynn, inflation has dropped like a stone from as high as 9% to now just below 3%, so less than 100 basis points, within the Federal Reserve's mandate of 2%, its target of 2% inflation. How are you thinking about inflation? Uh, where do you think it is headed in the short and medium term, and what are the implications for that on the economy and markets?
Short and medium term, I'm kind of neutral because I think a lot of that comes down to energy. Um, when you have a decent amount of OPEC spare capacity, and it's hard to know what the exact numbers are, but you have a certain amount of reported spare capacity. And like we mentioned before, I don't think these Chinese stimulus are going to be like shock and awe. These aren't like trillion-dollar stimulus coming in. We're not seeing a pivot on the dime. And so I think that this takes time to kind of renew emerging market like energy consumption, for example. So I think that can head in the right direction over time, meaning like I think you'll see more oil demand because of a stronger global economy, but not necessarily right away. And it kind of comes down to like decisions of Saudi Arabia. So I have to get into like the Saudi mindset to fully answer what CPI or is going
Mm.
to do. And I try not to do that. So I think in the intermediate term, I'm kind of mixed on inflation. I think that the structural bias under fiscal dominance is higher average inflation. So I don't really see us returning to the 2010s period of like structurally undershooting their target. Um, and then I would note that to the extent that you don't get inflation, that kind of monetized fiscal deficit situation, the release valve is in those other types of financial assets. So you still, even if you're not worried about consumer price inflation, you're still worried about debasement of the denominator itself. And so you want to own scarcer things or things that pay you enough cash flow to offset the denominator debasement that's happening.
That makes sense. Well, how are you thinking about Bitcoin and gold, which have both been surging? Gold is at all-time highs. Bitcoin has been rallying for the past few weeks, but is not at all-time highs.
I'm bullish. I'm bullish both. I've been long gold since 2018. Um, in 2020, I got a little cautious around its kind of overbought status. I didn't necessarily think it was going to chop for like 3 years, but it did. And I just kind of stayed bullish, and it broke out. I was kind of looking for that kind of like breakout, and we got that. Right now it's a little bit overbought again, and the dollar's a little bit oversold. So I have some near-term concerns around gold, but I'm not really trading around those concerns. I'm still bullish with a 3 to 5 year view, and I prefer owning that to long duration treasuries in any sort of structural basis. Again, trades are trades, but it's like, what do you want to hold for 5 years? I would pick gold. Bitcoin, I'm pretty bullish on. I collaborated with Sam Callahan. We published a study the other day that kind of analyzed the correlation between Bitcoin and various measures of global liquidity. And we found that Bitcoin follows global liquidity more than any other asset. And so when you generally have either a weaker dollar or more credit creation globally, um, those conditions tend to be good for Bitcoin. And then you can temper that by looking at certain valuation measures for Bitcoin. We used market value versus realized value. So market value is just the market cap, and realized value is kind of like the on-chain cost basis. It's like the value of every coin the last time it was moved. Like what was the price in dollars last time it was moved on chain, which is often when people either send it to an exchange or pulled it from an exchange. Um, and when you get a really big bull market in Bitcoin, you get a really big kind of multiple of market value versus that kind of realized value on-chain cost basis,
Mm.
and that tends to presage forward bad returns for a few years and a breakdown in that liquidity correlation because that kind of bubble can unwind and override any sort of liquidity correlations for the next 12 months or so. And right now we're not really in one of those valuation bubbles. There's a pretty normal divide between market value and realized value. And I do think liquidity is probably going to look positive for the next 12 to 18 months. So I'm pretty bullish on Bitcoin. I don't really know what it's going to do for 3 months or so, but I am pretty bullish with an 18-month view. And we've generally seen periods where gold outperforms Bitcoin, periods where Bitcoin outperforms gold. Between the two, with Bitcoin's higher volatility, we've had better performance. tempered by its, higher volatility. And I think owning both as part of a portfolio is attractive. And I also, because I do venture work in the Bitcoin space, I also pay attention to a lot of the fundamental stuff that's happening. What companies are building new products on it? Um, what are some of like the technical developments happening? With the different layers of it. So it's a market that I follow pretty closely.
I know it is. How are you seeing liquidity? How do you measure it? Are you taking into account commercial bank lending, central bank reserve increases, quantitative easing, both of those? How do you factor into things that might not factor into liquidity indexes, such as, for example, private credit is not going to go on the St. Louis Fed's website for credit creation. So it might look like there's a recession when actually there's this huge amount of credit available in private credit. And Will, as you said, you think liquidity is going to increase for the next 12 to 18 months. Tell us why you think that.
So we use global broad money supply denominated in dollars, and that second part's important because it basically we talked about before the global dollar denominated debts that are out there, and so how much the dollar strengthens or weakens in the context of global credit creation really matters, and so that basically that takes into account broad credit creation and the relative kind of strength of those currencies relative to the dollar. The reason we picked that is because we want it to be fairly reproducible, so it's not like a proprietary liquidity indicator that no one can reproduce. It's basically saying, look, it's not a perfect indicator, but here's the indicator we used, and these are the correlations we found with the logic associated with it. I know that there are some liquidity measures, like Michael Howe, for example, that it's a broader one. Um, but includes more proprietary data gathering, harder to reproduce. In a perfect world, you'd probably have that. So you'd have like global M2, then probably global like all short duration government debt securities, um, and then you probably would incorporate some measure of bank tightening or loosening and of credit standards, and then private credit. Um, but I think that the benefits start diminishing. You get kind of the 80-20 principle where like if
Yeah.
once you're like 80% of the way there, you're not really like I never find that indicator is directionally differing from some of these more proprietary ones. It's more around the margins, and that's also why we focus on that valuation component because we found that having a good enough liquidity indicator and then combining it with a look into Bitcoin's valuations, that increases your like average likelihood of getting the direction right more than trying to squeeze every additional drop of juice out of your liquidity asset. The reason I think that liquidity is probably headed up in the next 18 months is because we're heading to a cutting cycle globally. And as we talked about before, some of these like bank credit indicators, if anything, they kind of bottomed in like 2022, 2023. They're still not good, but they're like less bad, let's call it, in rate of change terms than they were before. And I think that you'll have fewer headwinds from those happening. Then you add Chinese stimulus and you add, whatever else we might get. So my base case would probably be higher liquidity over the next 12 to 18 months, at a time when Bitcoin's not really overvalued by most of its different ways of kind of measuring overvaluation. And so that's why I have a fairly bullish view on both.
Thank you, Lynn. And so a key input into your analysis is just that the Federal Reserve has cut interest rates. It started off with a big fat 50 basis point cut to interest rates, and it's going to do more 25 basis point, 50 basis point cuts. We'll see. And that is stimulative because it encourages the creation of credit. And yes, it's true that often when the Federal Reserve cuts interest rates, it's during a crisis, and crises are not bullish. But if the Fed is cutting simply because inflation is falling and not because there's a crisis, that is bullish for liquidity, global markets, and the global economy. Just how stimulative do you think the Federal Reserve cut will be? I know that in one of your pieces you wrote about how you found it interesting that the China started to stimulate almost immediately after the Federal Reserve began to cut. Like, were they waiting? As well as how effective do you think the cut will be to markets if the 500 basis point of hikes was not as contractionary as people thought? We did not have a recession. Is the 200 to 300 to whatever, how many basis points of cuts we're going to get, is that not going to be that stimulative as well? Or is it? What are your thoughts?
So I've written about the fact that I think the Fed's a little bit overstated Like the attention on the Fed's a little bit overstated compared to what else we could be focusing on, including like Chinese stimulus, for example. Um, but that it's indirectly important. So I think that kind of like how the U.S. economy was pretty insensitive to rates on the hiking cycle because we locked in so much fixed rate debt at a lower level. I do think that we're going to be pretty insensitive on the downside too, which is that because a lot of mortgages were already locked in at much lower rates, the refinancing cycle I think is going to be kind of weak this time because there's relatively low mortgage originations during these really high rate couple years, and so there's not a ton of like free lunch mortgage refinancings to just do out there and stimulate. Um, and a lot of corporate investment grade corporations with fixed rate debt were already fine. So it's kind of the impacts on a little bit, maybe smaller businesses, maybe commercial real estate, some of these more troubled areas. So I think it's a lighter effect in the U.S. But then it allows these other countries to press their buttons too. So China, for whatever rate they might have factored in the U.S. decision, they now can pull their triggers a little bit more aggressive than they otherwise would. And you look at Brazil, they've had like double digit interest rates, like really high positive rates, trying to contain their inflation, trying to contain their currency debasement. And then to the extent that the U.S. rates go down, they can ease, and then therefore they can take off pressure on their economies. So I think that the it kind of has a pretty wide disbursement effect as the U.S. cuts and all these other central banks cut, especially when you combine that with the fiscal side. So the fact that the U.S. is running these kind of structurally high fiscal deficits, uh, again, gives you that kind of background stimulus. And so it doesn't mean that all areas run hot in real terms, but it generally means that things are pretty hot nominally. And then depending on energy inputs and things like that, you can get decent real performance as well.
The Federal Reserve dot plot projects interest rates on the longer run going down to 2.9%, and the market thinks they might go down as low as 2.8%. Do you have any big disagreement either way about, is the Federal Reserve going to cut more or less than the Federal Reserve has indicated and that the market is currently pricing in?
Not particularly. My view is not to try to second guess the market too much in that area. I don't really feel like I have an edge for what a handful of people in a room are going to decide to do. I do have a pretty high conviction that we are going to get a higher low in interest rates. Like I'm not in the camp that we're going to go all the way back to zero anytime soon, and that's relevant for a lot of different things. So I have more of that like big middle of the range view, and that a lot of it doesn't really matter too much because the fact that it's not going to structurally lower lows every time is a pretty big change.
Hmm. Thank you, Lyn. I so appreciate you coming on my show. People should check out your work at lynalden.com. People can find you at Lyn Alden Contact on Twitter. So, Lyn, you're one of the early guests on Monetary Matters. I guess I kind of want to ask you for advice and content ideas. What are something that you would want to see me cover on this interview that you think is not covered in financial media, either other independent financial podcasts or Bloomberg and CNBC? In other words, what are you interested and maybe keeping you up at night that you see very few people talking about?
That's a really good question. It's hard to answer because I think yours is one of the few podcasts historically that does cover a pretty really wide range of things. I think you bring on a really diverse set of guests that all have these different areas of focus. Sometimes I'm happy to see that there's an area that I was focusing on that's not getting attention, and you bring on a guest that like specializes in it, or you bring up someone that like I think there's a topic I wasn't focused on and kind of like put it on my radar. So I actually think it's not the best advice, but you're already doing great in that area. I think you want to have obviously people that can cover China as like it's kind of tied with the U.S. as the world's biggest economy, depending on what metric you're looking at. So obviously that's important to have kind of clarity into as much as we can. And but then you focus on domestic macro, focus on global. Uh, People that focus on gold or Bitcoin and energy, and I think you've already got a lot of your bases covered.
Oh, well, thank you very much. People can find Monetary Matters not just on YouTube, but on Apple Podcasts and Spotify. Lyn, thank you so much for coming on, and thank you everyone for watching.
Thank you. Just close the door.